Hello and welcome back to our quarterly perspectives, Q4 2023. This is Ryan Mahoney here at Cypress Asset Management, and I will be your host for this presentation. Herein, we will look at quarterly equity and fixed income performance along the frameworks of absolute and relative returns, as well as future expectations for market performance. We will next go on to discuss recent interest rate movements, as well as inflation expectations. And we will conclude with an examination of various asset classes and how they contributed to an overall portfolio return. We hope, as always, that you enjoy today's presentation. Now let's get started. We begin our discussion with a high-level look at a collection of major asset classes. As we can see from this illustration, U.S., developed, international, and emerging market stocks were all up during the fourth quarter. This is a reversal of the negative trend we witnessed during the previous quarter. Returns for bonds were also up for the quarter and for the year, both domestically and internationally. Next, let me draw your attention to the upper right-hand portion of the graphic here. The U.S. dollar was down nearly 5% for the quarter, and down over 2% for the trailing 12-month period. Now let's take a little deeper look at what was driving the returns of both stocks and bonds. We'll start by taking a look at how global equities performed for the quarter, and we will isolate the performance between U.S. and developed international stocks. The two charts here show the performance of different investment styles between the U.S. and international stocks. The bright blue bars represent the performance of different investment styles, and the dark blue bars represent the total market performance for the region. U.S. returns are measured with the Russell indices, and international market returns are measured with the MSCI World ex-US Index Series, which represent global developed market performance excluding the U.S. Now, as we can see from the dark blue line on the chart on the left, the U.S. market was up 12.1% in the fourth quarter, compared to up 10.5% for developed international markets on the chart on the right. Small cap stocks and large growth stocks on average both outperformed the market in the U.S. Small value stocks continue to lead the pack domestically, which continues the trend from the previous quarter on a relative basis. And internationally, growth stocks tended to outperform the market, with international large growth stocks posting the best performance for the quarter among the international development regions. But no matter the recent trends, it's important to keep in mind always that we should not make longer-term projections based on these short-term performances. Now we take a longer view to see how different investment styles have performed for standard periods ending December 31st, 2023. Looking at annualized returns in the U.S., we can see that markets have shown resilience, especially over the trailing one-year period. When faced with significant headwinds, such as renewed outbreaks of war in the Middle East, uncertainty surrounding the future path of interest rates, and paired, of course, with the apparent disconnect between where markets believe rates will go and what the Fed is actually projecting, and growing dysfunction on Capitol Hill, despite all of these potential issues, U.S. markets returned 26% during 2023 and have been nearing or exceeding 10% per year during longer time horizons. It's quite impressive. Large growth stocks had the best performance for the trailing one-year period, gaining 42.7%, which beat the U.S. market by 16.7%. We can also see that small and value stocks have generally been out of favor during these same time periods. And consequently, we expect that portfolios that have a small value tilt, such as those that we typically design for our clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer investment horizons. Keep in mind, however, that the very long-term evidence demonstrates that on average, small stocks outperform large stocks and value stocks outperform growth stocks. But size and value factors can still go through extended periods of underperformance like those shown here. Turning now to international markets, we see that large cap value stocks have led the pack over the one-year period. At the longer time horizons, we see varying performance among various styles, with value stocks, large cap stocks, and growth stocks each posting leading performance for the trailing 3, 5, and 10-year periods, respectively. Relating to the prior slides, we see that international markets have underperformed the U.S. market by 8.8% during the last 12 months, as well as at the longer time horizons, with 3, 5, and 10-year performance trailing by 4.8%, 6.9%, and 7.1%, respectively. However, as we'll see on the next slide, these relative performance numbers are not reason enough to abandon international stocks altogether. Thus far, we have discussed quarterly performance on a relative and absolute basis. Now, let's take a look at current stock market valuations and how they relate to future expectations and market performance. The charts on this slide show how expensive stocks are by measuring the price-to-earnings ratio, a very common metric used to value equities. The higher this ratio is, the more expensive the asset class is overall. Thought of in another way, these values depict how expensive $1 of earnings is. For example, as we can see in the chart on the top left, the average dollar earnings for the U.S. total stock market costs roughly $21. Internationally, as we can see in the chart on the top right, earnings are cheaper at just over $13 per dollar of earnings on average. The values represented here used historical fund as well as ETF data to establish the price ratios, and the average PE is reflected by the dotted line on the chart. These averages start in the first quarter of 2004 for U.S. measures and in the fourth quarter of 2006 for international stocks. Noting the strong market performance during the last 12 months, we see both broad U.S. and international markets are now trading close to or above their recent historical averages. We can also see that small value stocks in global developed markets appear cheap relative to their recent historical averages. All things being equal, we'd like to pay less for a dollar of earnings. These valuation ratios aid in setting expectations about the future. Low valuations today imply higher future returns and vice versa. The recent strength in broader U.S. market performance means that it's reasonable to expect lower returns than in the past when valuations were below their long-term historical averages. And the opposite is true for international markets and small value stocks globally. Now, it's reasonable to expect higher returns than the past when valuations were above their long-term historical averages. And I'll emphasize that this is a long-term relationship, and that short-term outcomes will likely be dominated by unexpected market forces. Now here we have the same analysis but isolating U.S. equities so that we can see how valuations compare across different styles. Recalling the annualized performance slides, we know that large growth has had an exceptional 10-year period. We can see that the growth in prices has exceeded the growth in earnings as the PE ratio has climbed to 31.8 to close the quarter, which is above its average since 2004. Small value, on the other hand, even with its outperformance to large growth during the last quarter, still has a PE ratio of only 10 and remains under the average since 2004. Now, although many investors may be interested in chasing returns of large growth companies, especially now, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted to small, relatively inexpensive companies. Next, we'll take a look at fixed income performance, the shape of the current yield curve, and how the market is currently pricing in inflation. The charts on the screen here show the average performance of different bond maturities in the segments of the fixed income market that we commonly track. As you might know, we typically prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left side, we see that bonds of all maturity ranges had positive performance, but markets favored longer maturities relative to short or intermediate maturities, with the 10 to 20-year segment posting the largest gains because of their increased sensitivity to falling interest rates. The chart on the right shows the performance of different intermediate maturity credit quality bonds. Here we see again that all bonds in the credit qualities listed were up for the quarter, with investors favoring corporate and municipal debt relative to the other credit segments. Next, we will look at the Treasury yield curve and what it might mean for returns going forward. Here we plot the yield curve to show the current yields for Treasury bonds at different maturities. The light blue line represents current rates, the dark blue line represents rates from the end of the previous quarter, and the gold line represents rates from 1 year ago. With the exception of the ultra short-term portion of the curve, rates decreased for all maturities during the quarter. As stated previously, this benefited longer-dated maturity debt. Looking forward, expected returns for fixed income remain elevated relative to the pre-pandemic era due to the Fed's rate hike program. For long-term fixed income investors, this is likely to be a net positive, as new money in maturing bonds are reinvested into higher yielding bonds. The yield curve remains inverted, as it was at the end of last quarter and the quarter before that, although less so than earlier this year. When this happens, particularly when the 2-year and 10-year points in the curve, between those 2 points rather, it is widely regarded as one of the precursors but not as a guarantee to an impending recession. Finally, we plot the market's forecast of inflation by taking the difference in yield between U.S. Treasury bonds and TIPS at different maturity levels. Like the previous chart, the bright blue line represents current inflation expectations, the dark blue line represents inflation expectations from the previous quarter, and the gold line represents inflation expectations from 1 year ago. Current market estimates for future inflation have been little changed compared to the prior quarter and this time last year. Now, even though inflation readings have continued to moderate, the Fed has been persistent in its stance that it is too early to declare victory over inflation. Because its 2% inflation objective has yet to be met, it will need to show evidence, or see evidence rather, that inflation is able to stay at that target in a sustainable long-term manner. To that end, future rate hikes have not been completely ruled out as of their December 2023 meeting. The Fed will be watching growth in the economy service sector, which is less sensitive to interest rates, as well as the housing sector, which has been showing signs of picking back up as mortgage rates now fall from recent highs. As these expectations continue to change, it is important to recall that these levels of inflation are baked into prices today. The markets are pricing an average inflation rate of approximately 2.1% per year for the next 5 years. And the market collectively expects inflation to similarly outpace the Fed's 2% target over the next 30 years. Not only are these expectations baked into bond prices, but they're also, of course, baked into equity prices. So making a bet on higher inflation would mean that we expect inflation to exceed even the current forecast. Okay, next let's take a look at how some major asset classes contributed to a 60-40 index mix this quarter, and how that mix might behave, or rather how it has behaved during recent history. Here on the slide, we look at the absolute impact of different asset class returns on the quarterly return of a sample 60% equity, 40% bond index mix. With stock and bond markets moving jointly upwards this quarter, we can see that all asset classes contributed to the overall increase of the mix. U.S. large cap stocks were the largest contributor for the quarter, while emerging market stocks had the smallest contribution to overall return. Diversifying stocks across geographies and investment styles, as well as allocating to bonds, helps to avoid undue portfolio concentration risk, while also allowing for ample growth this quarter. This resulted in the 60-40 index mix achieving a return of 8.2% versus the total U.S. market return of 12.1%. The portfolio thus is able to achieve about 68% of the stock market return, while also being exposed to only 60% of the stock market's risk. Here now we see a collection of major asset class calendar year returns displayed on a quilt chart. Looking at year-to-date returns in the rightmost column, we see that all asset classes posted positive performance, with the S&P 500, a popular headline index primarily tracking U.S. large growth company performance, gaining the most value at 26.3%. We can also see that performance of each individual asset class tile shows no predictable return or relative ranking from one year to the next. Quite the random walk. A diversified index mix, such as the 60% equity, 40% bond index mix shown in the white tile, tends to stay away both from the extreme returns, negative and positive, on a yearly basis and over time, while also dampening the volatility of returns. This is an example of one of the potential benefits of a well-diversified portfolio. It also helps us as investors to stay in our seats through any given quarter of market turbulence and not take away from our ability to prosper from the many quarters to come. And with that, we have reached the end of today's presentation. Thank you for joining us as always, and we will see you next quarter.